Okay, so what if I told you there's this little-known tax rule that lets your parents pay your student loans, but you're the one who gets to take the tax deduction? I know, it sounds way too good to be true, but it's a real IRS-approved strategy. So let's break down exactly how it works. Here's what we're going to cover. First, we'll look at a super common tax trap that trips up a ton of families. Then we'll get into the IRS's clever little workaround, the 2 golden rules you absolutely have to follow, and how this whole thing creates a huge tax-saving opportunity. We'll also clear up some questions and then wrap it all up into a simple game plan. All right, let's dive right into a scenario that plays out all the time. A parent wants to help their kid pay down student debt. It's a really generous thing to do, but it often creates this weird problem where a valuable tax deduction just poof, vanishes. Nobody in the family gets to claim it. And that brings us to the big question here. When a parent who's doing pretty well financially steps in to pay a loan that's actually in their child's name, who gets to deduct that interest? You'd think someone would, right? Well, the answer is often nobody. Yeah, it's a classic tax catch-22. On one hand, the parent often can't take the deduction. Maybe their income is too high or, and this is the key part, it's not legally their debt. Then you have the child. They're legally on the hook for the loan, for sure, but they can't take the deduction either because they didn't technically make the payment. So the end result? That tax break just disappears into thin air.
But here is the really good news. The IRS actually recognized this was kind of unfair. So they created a specific workaround, a really clever solution that's hidden right there in their own regulations that solves this exact problem.
And this whole solution is built on something called the Constructive Receipt Doctrine. It's basically a legal fiction. Think of it as the IRS just pretending the money moves in a different way so that the tax treatment matches what's really happening. So instead of one direct payment from parent to lender, they imagine a 2-step transaction. And here's exactly how that 2-step process works in their eyes. First, the IRS says, okay, that payment from the parent, we're going to treat that as a tax-free cash gift to the child. Then, step 2, they say the child is then treated as immediately taking that gift money and making the payment to the loan company themselves. It's a simple, kind of elegant rerouting of the money for tax purposes. So what's the bottom line here? It's huge, because the child is now treated as having made the payment themselves. They get to claim the full student loan interest deduction. We're talking up to $2,500 a year, even though that money never actually touched their bank account. Now, this strategy is awesome, but it's not a free-for-all. There are 2, let's call them golden rules, that are completely non-negotiable. You have to follow these for this to be legit. Okay, golden rule number 1 is super simple, but it is absolutely critical. The student has to be the one who is legally on the hook for that loan. Their name has to be on the paperwork as the borrower. This is the entire foundation of the strategy. And this brings up a really important point. This strategy does not work for Parent Plus loans at all. Why? Well, because with a plus loan, the parent is the one, and the only one, who is legally obligated to pay it back. The student has 0 legal obligation, so they can never, ever deduct the interest on that loan. It doesn't matter who writes the check. Golden rule number 2 is all about the dependency test. For the tax year that these payments are being made, the student cannot be claimed as a dependent on their parent's tax return. If they are, well, this whole strategy is off the table for that year. Period. Now, you might be thinking, wait a minute, why would I give up claiming my child as a dependent? And that's a fair question. But let's just do the math real quick. The parent gives up the credit for other dependents, which is worth about $500. Okay, but if the child is in the 22% tax bracket, that $2,500 deduction is worth $550. So for a lot of families, giving up the smaller credit to get the bigger deduction is absolutely the smarter financial move. Okay, so we've got the rules down. Now this is where it gets really powerful. This is where it becomes a form of tax arbitrage. It's all about shifting a tax benefit from someone who can't use it to someone who can. So here's the typical setup. You've got parents who can afford to help their kids out, which usually means they have a pretty high income. For tax stuff, this is measured by their modified adjusted gross income, or MAGI. And in 2025, if parents filing jointly have a MAGI over $200,000, they get zilch, for the student loan interest deduction. They're completely phased out. But now look at their kid, the recent grad. They're probably making well under the $85,000 threshold for single filers. What does that mean? It means the child is perfectly positioned to take the full deduction that their parents are completely disqualified from. See where this is going? This table lays it all out for the 2025 tax year. You can see a single filer gets the full deduction all the way up to an $85,000 MAGI. Then it starts to phase out. For joint filers, those numbers are much higher, but they phase out completely at $200,000. This income gap between the generations, that's the engine that drives this entire strategy. All right, let's quickly tackle a couple of common what-if questions that always pop up. What happens if a parent is a co-signer, and do you really need to worry about gift taxes?
So if a parent co-signs a loan, they're also legally on the hook. What's the best move then? Well, as long as the student is not a dependent, the cleanest and usually best approach is to just stick with our strategy. Treat the parent's payment as a gift. This lets the student, who again probably has a lower income, take the deduction. That's what gets the biggest tax break for the family as a whole.
And that leads right into the gift tax question. I mean, the IRS is treating these payments as a gift, so does that open up a whole new can of worms with taxes?
For the vast, vast majority of people, the answer is a big, fat no. For 2025, you can give up to $19,000 to any single person without even having to file a gift tax return. And if you're a married couple, you can give up to $38,000. Most family student loan payments are going to fall way below that limit.
All right, we've covered all the moving parts. Let's put this all together into one final actionable game plan for you. Think of this as your cheat sheet for the 2025 tax year. Remember, the deduction maxes out at $2,500. The child has to be the one legally responsible, so parent plus loans are out. Crucially, they cannot be claimed as a dependent. And the whole thing works because the child's income is below those MAGI limits, while that generous gift tax exclusion means you probably don't have to worry about any extra paperwork. You know, this strategy is just a perfect example of how digging into the fine print of the tax code can save you real money. It lets families work together to lower their overall tax bill, and it's all completely above board with the IRS. So the only question left is, are you putting it to use?